The market is starting off the week pretty good, but is it a little too hot for the Fed's liking? On today's show, we're going to jump into the state of the market, what we're looking at this week from an economic and earnings report standpoint, as well as some of the technicals underlying Bitcoin, Ethereum, our favorite cryptos. Before we get going, please hit that like button, subscribe to our channel for more mediocre market advice. Nothing we say today is financial advice. Do your own research. We are not experts. We are not financial advisors. We're just two guys who really enjoy keeping track of the market and talking about it. Kevin, it's Monday. We got about 9 days until the next FOMC meeting. We saw a pretty good weekend for crypto. The stock market is off to a good start this week. As an NVIDIA investor, I am very much liking what I'm seeing at the moment. How are you feeling about everything?
I was just taking it one day at a time. It's always just, for me, it's always convenient how everything always leads up to Jerome Powell and the Fed and FOMC. It's like either the price is just getting destroyed leading into it because people are afraid what they're going to say, or it's just pumping like crazy. So who knows? Might see a buy the rumor, sell the news event. Maybe we see a bull market. I have no idea. But there's some things in the charts that do tell us, maybe the outlook for the next few months isn't as, rosy as everyone would like to paint it right now. So yeah, I'm very neutral at the moment. I think that, well, not neutral, I'm bearish, but I'm neutral taking all this stuff in as it comes.
Yeah. The people who trade based on astrology are very bullish at the moment because Uranus isn't going to be in retrograde or some shit until April. So, we got that going for us, which is nice.
I can tell
but honestly,
I was going to say, depending on whatever Jerome Powell says, Uranus is going to be wrecked if you keep that's about the extent.
Yeah, man. We can move past Uranus. I just wanted to drop the astrology. You gotta love people who trade based on. It's so convenient how these periods that they're talking about always lead up to like major events that are happening. It's like, no, it's not. It has nothing to do with the stars. It has everything to do with what is on the docket for the coming, weeks and months. But anyway, it wouldn't shock me if we went into a little bit of a, bullish start to the year. Q1 tends to be fairly bullish a lot of years. It wasn't last year, but I think that the best you could call this would be a relief rally because we're not back into a bull market. Like we talked before the show started, we saw earnings from banks over the last, week, 2 weeks. Not only are they expecting more defaults, from individuals moving forward, but they're planning for a recession. Like they're putting the steps in place now that they would, do if a recession were here. So like they're getting ready for it. They see it coming. Their analysts are going to be smarter than you, than me, than all of the other YouTubers and content creators talking about the market. So to come out and say that, oh, we're back in a bull market, I think shows that people are a little out over their skis, if you will. And I think that you just need to be very cautious. Like Q1 of this year, if you've been holding on to crypto, I'm not telling you to buy or sell anything, but I'm going to be looking for opportunity to, reduce my position in the crypto market when possible, whether that's, selling some ETH or BTC, selling some of my NFTs and converting those over to USDC. I'm already kind of in the process of doing that as we speak. So, I could see it going higher. Like, could ETH approach 2K again? Sure, I think so. I don't know if it's going to break through that, but I could see it getting there. Could BTC get back to 30,000 or close to it? Sure, like 28, 29. I feel like that's a good spot to take some profit, if you will. Like a bunch of the BTC I have right now, I got at like 19,000, last year. So if I can trim a little bit, make a little bit of a profit there, I'm not going to be opposed to it. But I just think you gotta be smart here. You need to keep a level head. Don't get too high. Don't get too low. This is a long, long ways until this is, back into a bull market.
Yeah. I mean, couldn't agree more. And like I always say, smart money is always the big money, right? So the banks obviously know how the market's going to trade, how it's going to affect, retail and everything like that. Retail is always last money in. They always get wrecked. They're always last money out as well. So that's enough to say that maybe, set your expectations for this bull market that a lot of people are technically calling is here.
Yeah, for sure. So this week coming up, we really have nothing big until Thursday. Like today, tomorrow, Wednesday, not a whole lot going on from a economic data standpoint. But Thursday and Friday, things start to get interesting. We have new reports regarding jobs, disposable income, consumer spending, home sales, GDP, inflation. There's a lot dropping on Thursday and Friday. So I could see us moving up over the next couple of days, maybe trade sideways a little bit one of these days wouldn't surprise me. And then I think Thursday we're going to start to get data, and I think we'll see a lot of volatility on those days depending on what that data is looking like. The GDP data should be really interesting. Last year, like we technically had back-to-back quarters of negative GDP growth, so that would signal a recession. But like everyone kept saying, it's not a recession. The jobs market is too good. Blah blah blah. So I don't know, like if we actually ever technically were in a recession, or if politicians just didn't want to say it, or what it is. But we'll get a better idea of where the GDP is at, and then the PCE on Friday, looking at inflation. If that comes in under expectations, I think the markets are going to respond favorably. But I think that could also lead to I think this could be one of those situations where we see a run up in the markets leading to Tuesday, or to Powell speaking on, what is it, next Wednesday? Yeah, he speaks Wednesday. I could see us like taking a nice run up leading up to Wednesday, and then Powell having to like put the hammer down and really let everyone know that like, hey, we are not, we gotta tighten things up a little bit more to get back to where we need to be.
Yeah, I could definitely. Again, I still think that it's going to be worse. Like his outlook is going to be worse than what a lot of people are anticipating. And I wouldn't expect anything less than liquidations going in both directions in the days leading up to the FOMC and then his speech. So yeah, it's going to be volatile. I think everyone anticipates that. I mean, last night, in the past 24 hours, we saw $140 million worth of liquidations. Did the price do much? No, it's right back to where it was technically over the weekend. So yeah, just a lot of volatility. People are just trying to make as much money as possible. And to me, that spells greed, and greed is never good in the market.
No, it is not. There are some earning reports this week. We're going to hear from Microsoft, Tesla, just kind of more data points as far as their forward guidance, how the markets have been impacting consumer spending, all of that stuff. I'm curious if we've seen Tesla bottom out. I mean, they got their asses kicked so consistently for so long. Like Tesla's having a really good day today, but year to date we saw a pretty good dip down to almost $100 a share, back up to 144.5 today. So a lot of these, I'm surprised that crypto isn't moving as much today with how much the tech sector is, but it feels weird, man. It doesn't feel like that big of a jump back up should be happening right now, but maybe it was just extremely oversold. So anything else you want to touch on before we get into the charts? I see a note here that you want to talk about Swift and Binance and how that's going to impact retail. So would love for you to jump into that one.
Yeah, absolutely. Just one thing on Tesla real quick. I just looked at the charts, and if everything I'm saying, and we've been agreeing on, like the economic outlook for the macro is going to be worse, $65 a share. That's going to be my target.
Okay.
So that's just one thing to mention.
Okay.
But yeah, let's hop into the.
So you're telling me I should short Tesla.
I'm telling you not to do anything, because clearly there's liquidations in both directions, and I got destroyed. If I was going to short from 17.5, I would have got destroyed. That's why I don't use leverage trading. But that just looks like a great buying opportunity, and looks like there's some pretty good support at $65. So something to keep in mind if it gets there.
Okay, let's move ahead then.
Yeah. For Binance and Swift, this was pretty interesting. I'm assuming this is Binance, the international one, where it's not Binance US, but they sent out an email to all their customers that Swift and the USD withdrawals and deposits wouldn't be valid anymore under $100,000. So pretty much that's just retail dropping money into the the exchange. they're not going to be able to put money on there. They're not going to be able to get money off starting February 1st until they find a new partner to do that Swift USD swap. And that's mainly because the bank that they're using just doesn't want to deal with the regulations and stuff like that. So it allows people with $100,000 or more to, deposit and withdraw, but it's definitely going to affect some retail. But it's really weird to me that February 1st is the day it starts, and that's when Powell and the FOMC are going to be talking. So could you imagine if it like dumps crazy and you want to buy like a ton of Bitcoin and you can't get your money on there, or if you have a ton of money on there and you can't sell anything because they can't do that swap. So it'll be really interesting to see if that really affects anything with the FOMC, but personally, that's not something that I like to see at all. They haven't found the partner or bank that will do it yet, and they said that they can't guarantee it's going to be solved by February 1st.
Everything okay over there? Someone just drop a keg or something?
Yeah, that was one of the CEOs of FLOLiO that just dropped a bowl of cereal, I'm assuming. Sounded like it. But yeah.
Fantastic.
Maybe he's listening to our podcast.
Shit himself because he's just like, I can't get money on finance. All right, let's move into the charts then. Actually, you know what? Before we do the charts, I want to get into. You put a really good bunch of points into our document here. Our show notes about why the Fed can't ease too soon. So let's do that first, and then let's get into the charts.
Definitely. So the reason I think that the Fed cannot lower rates or pivot too soon is because historically we've seen that with every time the Fed eases, strict monetary policy, we end up with spikes in inflation. So back in 1970, inflation was at, I believe, 5.86%. And, a few years later, after they had eased rates, after raising them, we were at, 1974, 11.05%. And then a few years later in 79, we're at 11.25% and 13.55% in 1980. So the 70s into the 80s was a terrible time in terms of inflation. Everything was rising. A lot of it had to do with the Vietnam War, just poor government spending, and obviously wage growth, which meant that products naturally go up in price. And then there was a huge oil crisis in the 70s and the 80s. So that necessarily isn't great for inflation. We see how important the oil was earlier on when it was really expensive during the Russian-Ukraine war, how much inflation spiked. But regardless, inflation was spiking every time the Fed would ease too early. So they would just lower rates. But the bad thing was that in 1980, Paul Volcker, who's regarded as one of the most important chairmen of the Fed in history, the dude had raised rates to a point where it was almost 20%. So the federal funds rate was nearly 20%. And, this is from 1970 till I would say 1986 when the inflation really got to a point where it was under 2%. It was at 1.9% in 1986. That's a huge amount of time, and people are just getting destroyed. Again, it's going to be people who are going to be like middle-class America who are end up getting hurt the most by this. You can't use credit. Rates for loans and stuff like that are going to be expensive. So it just naturally just destroyed them. And I think Jerome Powell, in a way, sees that he can't allow that to happen again because that would just be detrimental to the United States. I mean, we're due for a recession. The last one we had was in 2008. And I think a lot of people are comparing this one to 2008 when they should be comparing it to the 1970s and to the 1980s, because if we are getting too bullish right now and we're getting too lax and we're seeing good numbers, but there's still things on the horizon that necessarily could lead to spikes in inflation. Like we could be at that point where we're just seeing nasty federal funds rates, like I'm talking like 10% or higher. And we don't want that at all. That's not something we want to see. That's going to be terrible for the markets. And short term is just going to be terrible for everybody. So this seesaw effect of going back and forth, between, oh no, recession's over into another recession. It's not something that I think Powell and the Fed really want to see. And I think that's why they're going to be a little bit more hawkish than maybe investors and retail are currently seeing.
And, that was supported by the minutes from the December FOMC meeting. Powell stating, or the Fed stating that, they think that we're going to have to obviously continue to go higher with the rates and then be comfortable staying there for a while. So my prediction still of 25 basis point hikes at the February meeting, the March meeting, and the May meeting. I'm still going to stick with that. And I wouldn't be surprised if they keep the rates there for the following 4 meetings and maybe they pivot and lower the rates at the December 2023 meeting. Like, that wouldn't surprise me. I think that they're looking at what happened in the 70s, obviously before our time, but they're looking at that and trying to be like, okay, we're not going to do what they did, and we're not going to lower these rates. They've said over and over and over again that before they ease the rates, they're going to pause, and they're going to pause for a while. It's not going to be like they raise, they pause for 1 month, and then they ease the following meeting. Like, I think it's going to be, 3, 4, 5 months of the rates just staying flat where they are, seeing what impact that has, and then they begin the easing process, or they have to hike again. Like, I don't think there's any guarantee. People who are expecting them to be easing rates midway through this year, I think, are going to be disappointed. But that's just my interpretation of what they've said, and how the calendar is going to play out and what they're going to need to do to get inflation where they want to be.
Absolutely. I think short-term pain for, long-term preventative destruction is probably the play that they're going for. And I'll be honest,
like I would rather, the market kind of and that's where I could see, like, they pause for longer than everyone expects. I can see that, leading to a leg down for sure. But I would rather just get this, I just want to get this shit over with. Like, I do not want this to drag out for 3, 4, 5 years. Can we just, take care of this shit now as best as possible and try to start the recovery sooner than later?
Yeah, I mean, that's why I'm like, just drop a 50 in there somewhere. Like, obviously it's going to suck, and you don't want to see, rates go up, because then eventually people are going to lose their jobs. But the faster this gets over with, and we actually do a good job of, bringing inflation down and keeping it down, maybe not printing $1 billion fucking over the next 6 months or something like that, once, we get out of this recession or whatever we're in right now, then maybe, we can see the same type of growth we saw from 2010 all the way till 2020, 21. You know what I mean? So it's just a matter of just being responsible right now, and hopefully they exactly. That's that. I couldn't agree.
My buddy Dan made this one, and man, one of my favorite memes out there. It's very accurate though. The monkey JPEG market is going to take a bit of a beating for rates to get to where they need to be. So let's move on past that. Let's get into some technical talk here regarding the DXY, Bitcoin, and ETH, if you think there's any interesting things to discuss from that standpoint.
Yeah, absolutely. So those are the three that I really only want to talk about for the charts. So let's pull up the DXY. Okay. All right, you got. There we go.
So true. It is. All right, let's do it.
All right, cool. So the DXY, I'm looking at the weekly. Again, I just want to look at the stochastic RSI real quick for the weekly. Super oversold, right? We're undervalued. We've been seeing this since when? Peak was in September. So we've been shooting this way for about 3 going on 4 months now. And, we're just undervalued. The price is down, but we're trading in this channel still where we're finding support on historical support. There, touch there. And then I'm not going to go. Obviously, we see rejection there. So this is an important line, this blue line here. A little bit further down, there's still some support. But for the most part, we're holding strong. The DXY is actually in the green today, not by much. But, when you see these risk assets like the Dow shooting up to 407 today, 300 for the NASDAQ, 66 for S&P, Bitcoin's up about $400 right now. You expect the DXY to drop, but the dollar is pretty strong right now. So I wouldn't count it out yet. Let's look at the daily. The daily, we're nice and oversold. We've got a little bit of a cross here, but imagine when this crosses back, if we see a little bit of a pump. This is the 15 to 200 EMA on the daily. That would, to me, that's a bullish signal. We have to cross over again. Again, it's been trading down for the longest, so clearly the 50-day moving average is going to move faster than the 200. But if we see some FOMC stuff where risk assets are probably going to take a bit of a hit, the dollar shoots up, that's a bullish cross for me. And I think that with everything paired with the DXY, we have pretty good momentum and room to the upside. And that could just destroy markets in terms of the value of these risk assets. Will that happen? I don't know. I really can't tell how the market is reacting. I think the fact that the DXY and other risk assets are doing pretty well right now tells you that a lot of people aren't sure which side to be on.
But yeah, I've been saying this for months. I think the dollar is due for a huge pump, something similar to what we were seeing earlier, and I guess later in 2022, where it shot up to like 114. Will it go up that high? I don't know. Maybe if we get a double top scenario, but I definitely believe it should go up higher than this, than where we're currently trading. I think we're going to get a good bounce off this on the macro, but right now we're just trading sideways, and we're just waiting to see what Jerome has to say in a few days. So that's what I got for the dollar. Nothing too crazy.
Okay. Big Daddy Jerome. He's on his way to town. Let's get into Bitcoin, ETH. We've seen some nice price action there. Last week I said I had to buy some ETH in anticipation of a few NFT things, and I'm sure I was going to be buying the top. But you know what? I did not buy the top yet. So I'm just kind of wondering, what should I be doing with some of that ETH? Is it a good idea for me to, maybe sell a little bit of that back, take a little bit of profit? But, let's see what we got going on here.
Absolutely. I'm glad you didn't buy the top. I'm glad you're a bottom buyer. That's the way to be. But
I didn't buy the absolute bottom, but I'm feeling better about it now, at least.
Any bottom is better than no bottom. Let's say that. So,
amen, brother.
All right, getting goofy here. Let's see. So let's look at this 50 and 200 EMA on the weekly. We're seeing that 50 EMA is starting to curve a little bit. Obviously, that's because the price shot up like a freaking rocket. But again, the 50 moves way faster than the 200. 200 still moving sideways. I still want to see this hit the 200 EMA. There's just so much going on in this area right here. We're waiting for a death cross. Maybe we see it, maybe we don't. I still believe we're going to see it. But this 200 EMA is also massive resistance. If you're below the 200 EMA on the weekly, tends to be a bear market, right? If you're above it, people will tend to get bullish. Would I be surprised if we shot above it and then wicked right below it and then find resistance on the 200 EMA? Not at all. I think that might be the play here. And a lot of people are just going to get trapped going long when it goes above it. But we're just going to have to wait and see. We saw that the weekly close last night happened, and we are now completely into the overbought territory. And it's pretty clear that we're overbought. So I don't know if this 200 EMA is going to serve as like massive resistance that just is the catalyst for bringing it down. We'll just have to wait and see. But it's just weird how everything is lining up right now between the FOMC, this death cross, the 200 EMA on the weekly, and the price. They're all like, everything's just lining up perfectly. It's like we're playing 4D chess over here in the charts. So that's one thing to keep in mind. And I also wanted to look at the last bear market rally that we had in June to August. If I can find it. There it is. So that was from here to there. And I was doing the charts earlier, I believe. Let me just see. I believe it was 45% move for a total of around $7,500. Again, I'm rounding here, but it was a 45% move from where we were at like 17.5 all the way to, where did we get to? What was that? Here. We got to like 25.15. So, pretty good move. But that took about 71 days to complete from bottom to obviously the breakdown. That's what I considered. And right now, from the bottom where we hit the low, which would have been, a little bit after the FTX collapse, that would have been about 63 days that we're currently sitting at. So also came up about $7,900. So it's very similar to these two rallies, and we're still in a bear market. And again, pretty overbought. It just seems like the timing and the amount of money that we've actually progressed in from where we were is lining up pretty evenly. Again, that might not be anything. That's just something that I noticed when I was looking at the charts last night. But that's what I'm seeing. This one just seems a lot less natural, whereas the other one seemed like it traded a lot more like a market. We see that we just came up and down, trading within this range, whereas this thing, we just traded sideways for about a month and a half, and then we just shot up into space. So it'll be interesting to see if this plays out similarly, or if we just see a massive red candle. Again, I have no idea. Just the market's just liquidating everyone in sight. But it'll be really interesting to see once we get this FOMC meeting out of the way, and maybe even see some of that price hit those weekly 200 EMAs.
Okay. Let's dive into, what do you want to talk about next? We want to go with
We can do ETH.
Some of our alts. You want to do ETH? Okay.
Yeah. Again, with a lot of these alts, Bitcoin's going to have to come down for anything crazy to look at. You know what I mean? Like we could talk about lower time frame trades, but for the most part, I would not touch that at all just because of how much we've seen, liquidations, and we're pretty overbought. So I would anticipate a lot of longs opening up for some of these alts who just get destroyed once the short positions for Bitcoin and everything just start getting whacked.
Okay, so let's get into ETH, and then we can kind of wrap it from there.
Yeah, absolutely. So for ETH, it's very similar to Bitcoin. Obviously, the ETH daily stochastic RSI is coming down pretty nicely, but for the weekly, we can see that we're overbought and hit this double top right here. This is around 1680. We just hit there back in October, and it looks like we hit there back on last week, Monday, January 23rd. But again, we're getting close. We're above the 200 EMA, so I wouldn't be surprised if there is a little bit more push to the upside. Like I said, at least the stochastic RSI is coming down. I wouldn't be surprised if that finds maybe some support on the 200 EMA for the daily. Maybe we test this again, get a double top, actually a triple top at that point, and we find some rejection. But right now, I'm seeing nothing too crazy. I did notice that, where was it? Over here. Every time that on the weekly we break above the 200 EMA, we tend to find a red candle right after it. So let me pull up the weekly for ETH. And yeah, here it is. So since August, we started seeing this. We broke under it. We shot up, green candle up right there. Just make it bigger. And we found the next candle was a fat red rejection. We came back up here, tested it again, red candle, fat rejection. Currently, we're above it. And looks like last night we closed above the 200 EMA. And this week, we're currently green. Does that mean that we potentially see a red candle that comes below it right before FOMC? Or we could just potentially see, maybe another similar candle where it stays in this range and we find rejection maybe the week after. But it's just another trend or pattern that I'm seeing. And yeah, there's nothing too crazy. I think that maybe we get a tap of this 50 estimated moving average. But I think a lot of this depends on what Bitcoin and the FOMC has done. I think we've seen impulsive moves across the entire space, but I think there is definitely some divergence in Bitcoin and with dominance. It should bring alts down with it.
Okay, you heard it here first.
Nothing too crazy with those.
Nothing too crazy. I think this is we wait. We look at some of this data, and we kind of move on from there. But like I said, I'll be looking for opportunities to maybe, my current plan is take some in cash, take some profits from things, keep some of it in ETH, for my long-term holdings, but not trying to be overly, I know it pays to be, to have conviction, but right now it feels like, a too heavy conviction could get you wrecked pretty bad in either direction. So I'm just kind of taking it one day at a time right now. I think that's the best we can do.
Yeah, definitely. I also will say, though, if you do have conviction, it's always good to make sure you're backing up your convictions with data and reasonable information that makes you believe in that conviction further, because you don't want to be the person, like everyone I know right now is turning mega bullish out of nowhere. And what happens next week if this just ends up being a massacre? Yeah. A month from now it could be a massacre.
It's like, is your conviction based on what you want to happen or what you think is most likely to happen? And there's a huge difference right there.
Yeah, exactly. And another thing, this is adds to my conviction, but one thing I was reading up a lot over the weekend was the auto industry, and tons of people just have ridiculous amounts of debt that they owe to these car companies and dealerships.
I'd be interested to know if there's historical data, because there have been a ton of car repossessions. Is there a trend in the past of car repossessions kind of being a forward-looking indicator of bankruptcies and home foreclosures? Do we ever see that kind of have we seen that progression happen in the past?
I want to say 2008, there was a huge amount of car repossessions and bankruptcies. Like people just like can't afford it, so they just let it
leading
go.
up to the housing market crash.
You know what? How about I do some research on that, and then for the next show we just talk about it for a little bit, because that's actually like this came out of nowhere. I mean, now I see a good amount of people are talking about just how much people are their vehicles are being repossessed. I don't know if they just don't care, or if they just can't afford it, but it's definitely pretty interesting considering like the entire auto industry, the entire auto market might get like completely wrecked.
Yeah, I think there's that's just another like I get, at the end of the day, like using the stock market as your indicator for the health of the economy is not the best thermometer to be using, if you will. Like there's a lot of other indicators besides what, because less than 10% of people have money in the stock market. Like, try to keep your eyes open to a lot of different things and not just focus on any, not just like one or two data points.
I just see a house of cards. That's all I see.
Yep, I'm right there with you. Okay, well, that is going to wrap it up for today. Kevin will do a little bit more research there. We'll kind of look at what we've seen in the past regarding, car repossessions, home foreclosures, all that not fun stuff that is important. So we'll be back Thursday afternoon. Thank you, everybody, for watching. We really appreciate it. Hit that like button, subscribe to our channel, share this out with any friends you have that are interested in finance. We love talking about these things, the markets, all that good stuff. So for Kevin, for the team at FLOLiO, I'm Jeremy. Have a great day, everybody. We'll be back on Thursday.
Have a great day.